The US dollar just lost something it hasn't lost in over 30 years. And no, I'm not talking about a trade deal. I'm not talking about a recession. I'm talking about the one metric that quietly tells you more about America's financial future than any jobs report, any GDP print, or any speech from the Federal Reserve. According to the IMF latest data, the US dollar's share of global foreign exchange reserves just dropped to 56.8%. That is the lowest level since 1994. Let me say that again. The lowest in 31 years. At the same time, the dollar index, the DXY, is sitting around 98.9 as of this week, down from over 107 just a little over a year ago. Gold is trading above $4,700 an ounce. Central banks around the world bought roughly 850 tons of gold last year, and they are on track to do it again. Foreign central banks have slashed their U.S. Treasury holdings at the New York Fed to the lowest level since 2012. China has been a net seller of treasuries for 9 consecutive months. And right in the middle of all this, a shooting war in the Middle East. A Strait of Hormuz that just reopened under a fragile ceasefire. Oil that briefly touched $116 a barrel. And an administration in Washington that, by design or by accident, seems to be engineering the weakest dollar in a generation. This is not clickbait. This is not speculation. This is the math. And if you don't understand what is happening right now, it will cost you. Let me explain. Alright, so let's set the stage, because this story has about 6 moving parts that all collided at the same time. Going into 2025, the consensus on Wall Street was that Trump 2.0 would be dollar positive. Tariffs would restrict imports, creating scarcity of dollars overseas, which would push the dollar up. That was the playbook, the textbook theory, and for about 5 minutes it worked. The DXY briefly touched 109 in early 2025. Then, everything flipped. By April 2025, when the administration rolled out its reciprocal tariffs in the most chaotic way imaginable, the dollar didn't strengthen. It cratered. The DXY fell about 3% in 48 hours. CNN, CNBC, the Financial Times. Everyone ran the same headline. Trump's tariffs were expected to boost the dollar. They're not. Goldman Sachs published a note saying that U.S. tariffs were expected to weaken the dollar as GDP growth slowed. And that was just the beginning. By the end of 2025, the dollar had its worst annual performance in 8 years. Reuters ran a headline in late December. Dire year for the dollar, has little light at end of tunnel in 2026. Morgan Stanley forecast the DXY would fall to 94 by mid-2026. A roughly 5% decline from where it started the year. Now, as of this week, April 2026, the DXY is hovering around 98 to 99. It briefly dipped below 97 back in January, hitting a 4-year low. And while it is bounced off that floor, the broader trend has not reversed. Inding published an analysis in late February saying the dollar's 2026 decline looks more cyclical than structural. In other words, they're trying to calm people down. But here is the thing. When you need to write a research paper to calm people down, that itself tells you something. So why is the dollar falling when tariffs should, in theory, prop it up? 3 reasons. First, growth expectations. Tariffs are a tax on consumption. They raise prices on imported goods. When prices rise and wages don't keep up, consumers pull back. When consumers pull back, GDP slows. And when GDP slows relative to other economies, capital flows out. The Yale Budget Lab's own research showed that dollar appreciation from tariffs only offsets 30 to 50% of the tariff's cost. And that is in a non-retaliation scenario. The moment other countries retaliate, and they have, even that modest offset disappears. Second, the Fed is stuck. The federal funds rate right now sits at 3.5 to 3.75%. The Fed held steady in January, held steady again in March. The dot plot says maybe one cut this year. Wall Street brokerages are penciling in two, but JP Morgan's chief economist just came out and said no cuts at all in 2026, and a possible hike in 2027. Meanwhile, inflation just jumped to an estimated 3.3% in March, the highest since May 2024. The Fed can't cut into rising inflation, but it also can't hike into a slowing economy. It is trapped. Third, and this is the big one, confidence. The dollar's value isn't just about interest rate differentials or trade flows. It is about trust. And for the first time in a long time, that trust is being tested from multiple directions at once. Let's talk about the elephant in the room, or more accurately, the war in the room. In early 2026, the United States and Israel launched military operations against Iran. I'm not going to get into the politics of it. That is not what this channel is about. What I am going to talk about is the financial fallout, because it has been massive. When the conflict escalated in late February and early March, Iran effectively closed the Strait of Hormuz, the choke point through which roughly 20% of the world's daily oil supply flows. Oil prices spiked. Bloomberg reported Brent crude trading near $116 a barrel by late March, up 60% since the war began. As of the last few days, there is a fragile ceasefire in place. Oil pulled back hard. CNBC reported prices plunging after Trump agreed to a 2-week ceasefire that allows passage through the strait. But nobody is relaxed. Trump just threatened to bomb every bridge and power plant in Iran if the strait closes again. So we one tweet away from $120 oil. Now, here is why this matters for the dollar. The conventional wisdom used to be that war is dollar positive. Flight to safety. Everyone buys treasuries. Dollar goes up. That was the playbook during the Gulf War, after 9/11s, during the early months of the Ukraine invasion. This time, the opposite is happening. And Reuters explained why in a piece from the 1st of April. Foreign central banks are selling treasuries. Not dramatically, not in a panic, but quietly and steadily. The Financial Times reported that foreign central bank holdings at the New York Fed dropped to the lowest level since 2012. And the reason isn't mysterious. Countries are hedging. They rewatching the US government spend $1 trillion a year just on interest payments on nearly $39 trillion of national debt. Fight a war in the Middle East and simultaneously try to cut domestic spending through Doge. And they're saying, maybe I don't want all of my eggs in this basket anymore. The Dallas Fed published a study showing that if the Strait of Hormuz closure extended to 2 quarters, oil could settle around $115 a barrel. CNBC reported that the war tax is already squeezing American businesses and consumers. Higher gas prices, higher diesel, higher jet fuel. PIE, the Peterson Institute, warned back in January that inflation could exceed 4% by the end of 2026. With oil-driven inflation now layering on top of tariff-driven inflation, that is looking increasingly possible. And here is the kicker. This is happening while the government is paying nearly $1 trillion a year in interest on the national debt. The American Action Forum projects net interest payments will hit $1 trillion in fiscal year 2026 and double to $2 trillion by 2036. Forbes reported in March that with debt past $39 trillion, Americans are paying $900 billion annually just in interest. More than what we spend on defense. Let that sink in. Now, if you've been paying attention to this channel, or frankly any serious financial media over the last 2 years, you've heard the term petrodollar. But I want to take a minute here because the timing of what just happened is genuinely significant, and most people completely missed it. Fortune ran a piece literally 3 days ago, the 7th of April, 2026, with the headline, 2 years ago, Saudi Arabia quietly canceled the petrodollar deal with America that wired the world economy for 50 years. Then war broke out in the Middle East. Quick history. In 1974, the United States and Saudi Arabia struck a deal. Saudi Arabia would price its oil exclusively in US dollars and recycle its surplus dollars into US treasuries. In return, the US would provide military protection. That deal, the petrodollar agreement, was one of the single most important structural supports for dollar demand in the last half-century. Every country that needed oil needed dollars first. That created permanent, global, structural demand for the US currency. In June 2024, Saudi Arabia let that agreement expire. Quietly. No press conference, no headlines. Most people didn't even notice. But the implications are enormous. Without the petrodollar agreement, Saudi Arabia is free to price oil in yuan, in euros, in whatever it wants. And while the Saudis haven't fully pivoted away from the dollar, they're pragmatic, not ideological. The symbolic and structural shift matters. It signals that the dollar's role in global energy markets is no longer guaranteed by treaty. It is now maintained by inertia and convenience. And inertia is not a strategy. Now, layer on the BRICS dynamic. The BRICS nations, Brazil, Russia, India, China, South Africa, and a growing list of new members, have been actively working to reduce reliance on the dollar in cross-border trade. Russia is reportedly preparing to issue UN-denominated government bonds. India's RBI is pushing to link BRICS payment systems for smoother cross-border transactions. Is this going to kill the dollar tomorrow? No, but it is creating an alternative plumbing system that didn't exist 10 years ago, and every pipe that gets built outside the dollar system reduces the structural demand that keeps the dollar where it is. Here's where the data gets real. The IMF coffer data shows the dollar's share of global reserves at 56.8%, down from over 70% in 2000. Brookings published an analysis in February noting that the dollar has fallen about 10% on a trade-weighted basis since Trump's second term began. They made an interesting observation, though, that reserve managers haven't actually dumped dollars. The valuation-adjusted data shows that the allocation to dollars has been fairly stable over the last year. The decline you see in the raw numbers is partly just an FX effect. When the dollar falls, the percentage naturally shrinks. So the Brookings conclusion is that the hurdle for meaningful erosion of reserve currency status is very high, likely due in part to the lack of viable alternatives. And they're right, for now. The euro hasn't gained ground. The UN actually lost reserve allocations since Trump's second term started. The winners have been smaller currencies, the Swedish krona, the Korean won, the Singaporean dollar. But here is what I'd push back on. The absence of a single alternative doesn't mean the dollar is safe. What is happening is fragmentation, not replacement. Countries aren't moving to one new reserve currency. They're spreading their bets across many. And fragmentation over time is just as corrosive as replacement. It just happens slower. Now, here's the part that most people haven't connected yet. What if the dollar decline isn't just a side effect of bad policy? What if it is the policy? Enter Stephen Miron, the chair of the Council of Economic Advisors under Trump. Before he took the job, Miron wrote a paper that has been nicknamed the Mar-a-Lago Accord. It is essentially a blueprint for deliberately weakening the US dollar. The logic goes like this. The dollar is overvalued. It has been overvalued for decades because of its reserve currency status. That overvaluation makes American exports uncompetitive, hollows out manufacturing, and widens the trade deficit. So the fix, according to Miron, is to engineer a controlled depreciation of the dollar. Use tariffs as leverage to force trading partners to strengthen their own currencies. And restructure how foreign central banks finance US debt, potentially by swapping short-term treasuries for ultra-long-term, low-interest century bonds. Now, the Council on Foreign Relations published a piece in January 2026. Analyzing this, they noted that the accord explicitly calls for foreign reserve managers to sell dollars in order to strengthen their own currencies. Think about that. The US government's own economic advisor is publicly calling for the world to hold fewer dollars. That is a break from 50 years of US policy. Will the Mar-a-Lago Accord actually become a formal agreement? Probably not. Bloomberg ran a piece in January titled, "Why There Won't Be a Grand Mar-a-Lago Accord," arguing that the administration's real priorities are tariffs and tax cuts, not currency diplomacy. Harvard's Kennedy School called it misguided. Foreign policy called it something that makes no sense. But here is the thing. It doesn't matter if there is a formal accord or not. The policy mix is already achieving the result. Tariffs are weakening growth expectations. The war is spiking energy costs. The deficit is ballooning, the Fed is stuck, and the dollar is falling. Whether this is deliberate strategy or happy accident, the outcome is the same, and the bond market knows it. The 10-year Treasury yield is sitting around 4.29%. Right now, that is not panic territory, but it is elevated. And more importantly, it is elevated despite the fact that the Fed cut rates significantly from the 5.25 to 5.5. Oh, peak. The long end of the curve is not cooperating. Investors are demanding more yield to hold us debt, which tells you something about how the market views us fiscal credibility. And now we arrive at the one chart that, in my opinion, tells the entire story in a single line. Gold. On the 26th of January, 2026, gold blew past $5,100 an ounce for the first time in history. It briefly touched $5,595 a few days later. As of this week, it is trading around $4,700 to $4,800, pulled back by the Iran ceasefire and some profit taking. But to put that in perspective, gold was $2,000 an ounce at the start of 2024. It has more than doubled in roughly 2 years. Goldman Sachs just raised their year-end target to $5,400. Now, why does gold matter in this conversation? Because gold is the anti-dollar. When people buy gold, they're not just betting that gold goes up. They're betting that confidence in fiat currencies, and specifically the dollar, goes down. And it is not just retail investors driving this rally. The World Gold Council reported that central banks purchased roughly 850 tons of gold in 2025, and surveys show that 95% of central banks expect to increase their gold reserves in 2026. That is extraordinary. These are the same institutions that manage the world's foreign exchange reserves, and they are actively, deliberately, measurably reducing their exposure to the dollar and adding gold instead. Not because they're gold bugs, not because they watch YouTube videos about the end of the financial system, because their risk models are telling them that concentrated dollar exposure is no longer the prudent allocation it once was. China has been the most aggressive buyer, but it is not alone. Poland, India, Singapore, Turkey, they've all been loading up. And the reason is straightforward. When you see the US running nearly $2 trillion annual deficits, paying $1 trillion in interest on its debt, engaged in a Middle Eastern war, imposing tariffs on allies and adversaries alike, and publicly discussing a policy of dollar devaluation, you diversify, you buy gold, you build alternative payment systems, you quietly reduce your treasury holdings. That is not conspiracy. That is risk management. And here's the part that should concern you if you're an American saver or investor. When the dollar weakens, your purchasing power erodes, even if your nominal portfolio balance stays the same. A 10% decline in the dollar means everything you import costs more. Your vacation costs more. Your electronics cost more. Your car costs more. Inflation that you thought was beaten? At 2.4% in January, it is now estimated at 3.3% for March. And forecasts from PIE and the OECD suggest it could reach 4% or higher by year. And when you factor in oil shocks and tariff pass-through, that is a hidden tax on every dollar in your bank account. All right, so by now you're probably thinking, okay, the picture is bleak. The dollar is weakening. Inflation is creeping up. The government can't stop spending. What do I do with this information? Let me be clear. I'm not here to tell you to panic. And I'm not here to sell you gold coins or pitch some newsletter. But I do think there are some principles that apply regardless of where this goes. First, understand that the dollar isn't going to zero. The Brookings data makes that clear. There is no single alternative. The euro has structural problems. The UN isn't freely convertible. Bitcoin is too volatile for reserve status. The dollar will remain the dominant global currency for years, possibly decades. But dominant and strong are not the same thing. The dollar can remain dominant while losing 10, 15, 20% of its value. And that is what matters if you're trying to preserve your wealth. Second, think about what you're denominated in. If 100% of your savings, investments, and income are in US dollars, you have a concentration risk. That doesn't mean you need to open a Swiss bank account. But exposure to international equities, real assets, commodities, and yes, possibly some gold is a hedge against dollar depreciation. Morgan Stanley's own call is that the dollar could fall to 94 on the DXY before recovering. That is a real move with real consequences for dollar-denominated portfolios. Third, pay attention to the bond market. The 10-year yield at 4.3% with the Fed at 3.5 to 3.75% tells you the market is pricing in risk. If Treasury yields spike because foreign buyers step back, that hits everything. Mortgage rates, corporate borrowing costs, equity valuations. This is the scenario that keeps the Treasury Department up at night. And fourth, don't underestimate how fast things can change. A year ago, the consensus was that the dollar would strengthen under Trump. Today, it is at multi-year lows. The petrodollar agreement expired without fanfare. A war started in the Middle East that nobody priced in. Doge tried to cut government spending and Congress mostly reversed it. The deficit is wider than ever, and inflation is re-accelerating. The world isn't ending, but the rules are changing. The monetary system that has governed global finance since Bretton Woods, and especially since Nixon took us off gold in 1971, is being stress-tested in ways it hasn't been in decades. The U.S. national debt hit $38.98 trillion. As of the 3rd of April, interest payments alone will consume more than the defense budget this year, and the rest of the world is slowly, quietly, but unmistakably building alternatives. Here is the bottom line. What you're watching right now isn't a crash. It is not a collapse. It is a reset. A slow, structural renegotiation of the dollar's role in the global economy. It is happening through tariffs, through war, through debt, through policy, and through the simple, rational decision-making of every central bank in the world that looks at the math and says, I need to diversify. The dollar isn't dying, but it is repricing. And the difference between people who come out of this okay and people who don't will come down to one thing: whether you understood what was happening before it was obvious to everyone else. That is the information edge. That is the reset. And it is already started. I'll see you in the next one.